I don't think liquidity is going to be that robust this year. I think 2026 is likely to be a cycle peak for equities broadly, globally, and liquidity globally. I think there's a lot of things that right now look like tailwinds that are going to turn into headwinds kind of middle of this year, and that it's going to get tougher and tougher to be in a bull market, broadly speaking. I would not be surprised at all if we just stayed in this kind of funky zone, whether it's 85 to 100 or 75 to 95, I don't really know, but stayed in this zone and the spoofing just keeps happening. But at some point later this year, we break the ceiling and we get into a parabolic short covering rally. That wouldn't surprise me.
As Bitcoin continues to sit near historically elevated levels, consensus opinion across markets has once again turned aggressively bullish. Many investors are declaring that the 4-year cycle is dead, leverage is no longer a threat, and Bitcoin is destined for a straight-line move higher. Mark Yusko pushes back forcefully against that narrative, not because he is bearish on Bitcoin long-term, but because he believes that cycles, liquidity, and human behavior still matter. At the core of Yusko's argument is the idea that the Bitcoin cycle is not dead, it has simply been misunderstood. Rather than a clean 4-year calendar cycle, he describes Bitcoin's market rhythm as a 3-year and 11-month cycle, driven not by dates on a calendar, but by block production.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I was looking at the consensus for Bitcoin prices, and I think the consensus, again, as it usually is, just like stocks, is bullish. And people want to say that the 4-year cycle is dead and that it's up only and we're going back to the moon and all this good stuff. I'm struggling. So I was on record a year ago in January, which was not very popular, saying that the 4-year cycle was alive and well, and actually that it wasn't a 4-year cycle. It's actually, I call it 3.11. It's 3 years and 11 months. And that's because it's based on the number of blocks, not on a calendar. And so, December of 2017, November 2021, October 2025, that cycle has played out exactly as we would expect. In this 311 cycle, we get about a 360-day period that is crypto winter. And crypto winter lasts from the peak to, the next year. And in the 17 and 21 cycles, we had about an 84% drop and then a 74% drop. I argued that this time we were only going to get to about 50 to maybe 60% above fair value because there was less leverage. They'd taken some of the leverage out of the system. We didn't even get that far. We only got to 125. So we only got to about maybe 35, 40% above fair value being around 91. So long story short, the correction needed to be less. And so from 125 all the way down, I think we hit 80 at some point. That's a pretty meaningful correction. That's below fair value. So could we be stuck in this meandering range for the duration of the crypto winter, which would come sometime, September-ish, August, September-ish of this year? Yeah. So whether we stay in a range between 80 and 100 or 80 and 95 or 75 and 105, I don't really know, but I think that's possible. And so while it's certainly bullish when prices recover and rise, I don't see the momentum that you need to push back into a bull market until we clear out some of the tourists, I guess, the tourists who come in and lever up. I don't think liquidity is going to be that robust this year. I think 2026 is likely to be a cycle peak for equities broadly, globally, and liquidity globally. The other thing, and I'll talk about this in my 10 surprises, we've actually never made a new all-time high in Bitcoin when the PMI was below 50, meaning the manufacturing, was not in expansion. And we're, unfortunately below 50. I think there's a lot of things that right now look like tailwinds that are going to turn into headwinds kind of middle of this year, and that it's going to get tougher and tougher to be in a bull market, broadly speaking. And I just don't know that central banks have enough, bullets in the chamber to really fix things, because interest rates are already pretty low. And I don't think, generally speaking, companies need more debt. The big dogs can hold the price down. And so I would not be surprised at all if we just stayed in this kind of funky zone, whether it's 85 to 100 or 75 to 95, I don't really know, but stayed in this zone, and the spoofing just keeps happening. But at some point later this year, we break the ceiling and we get into a parabolic short covering rally. That wouldn't surprise me. So the short answer is short term, yes, long term, no. Depending on how much leverage is in the system, meaning the overall system, not just the Bitcoin system, but the overall system, will determine how much Bitcoin, gold, bonds, et cetera, give back during that deleveraging. The negative side of that is today, margin debt is the highest it's ever been. Now, margin debt as a percentage of market cap is not the highest it's ever been. So it's still a high number, but it's not as a percentage super high. So that's one negative, not super negative, but one negative. So, and why does that matter? Go back to 2000. So remember 2000, the world goes crazy. They run this drill and say everybody locked down, and the markets collapse. And Bitcoin fell 50% in 12 hours, right? 50% in 12 hours. Everybody says, see, it's totally correlated. I'm like, no, it's not correlated at all. And within a very short time, Bitcoin was back, and it took stocks a while for them to, print the money and start the rally. But Bitcoin bounced back really quickly. Why? Well, when you get a margin call, right? If you own a bunch of stocks and you have borrowed against them and you get a margin call and the stocks are down, well, you can't sell the stocks. So you got to sell what's not down. Well, what's not down? Cash, gold, bonds, Bitcoin. So all of those things fell in those first couple weeks of March in 2020, just like stocks. And everybody said, see, correlations are one. Like, well, duh, in a crisis, all correlations go to one. But then something interesting happened is they diverge. And bonds went back up and Bitcoin went back up. And if you bought that $5,000 bottom, that was a pretty good buy in March of 2020. Same thing with oil stocks. Everybody thought, oil price went negative in April for a couple, hours. Crazy. You had to pay people to take your oil. So long story is, ultimately, I think the same thing will happen if we get an unexpected decline and a deleveraging. People will be forced to sell Bitcoin, gold, whatever, and pay their margin calls. But the difference is, I don't believe Bitcoin is a risk asset. I don't believe that people that own it to speculate like they do NVIDIA or Microsoft or other tech stocks. I own Bitcoin as a savings technology. It's the greatest savings technology I think the world has ever seen.
Perhaps the most important part of Yusko's argument is philosophical rather than technical. He does not view Bitcoin as a speculative risk asset like NVIDIA or Microsoft. He views it as a savings technology, and in his words, the best savings technology ever created. Traditional savings are fundamentally flawed. When money sits in a bank or low-risk asset, inflation steadily erodes its purchasing power. This is not accidental. It is the design of fiat currency systems. Investing offers higher returns, but only by taking risk, equity risk, credit risk, innovation risk. Bitcoin, by contrast, allows individuals to save outside the system. Every time governments print money to fund spending, fiat currencies lose value. Bitcoin, with its fixed supply, gains value relative to those currencies.
In normal savings, right, you put your money in the bank and you put it in a low-risk asset to save it, and every day the government steals part of it back from you through this thing called inflation. That's a crappy system. It's theft. Then what do? Well, I would invest it. Okay, well, if I want to invest, I have to take some risk. I have to take equity risk or credit risk or innovation risk, and I can get a higher return. But the nice thing about Bitcoin as a savings technology is I can take it off grid, out of the system, and save it. And every day that government creates inflation to steal my wealth from my fiat, I get an increase. Now, it's a similar thing with real estate. I use the example of my house, right? According to Zillow, my house is worth twice as much as it was 5 years ago. My house didn't grow. It didn't get more efficient. In fact, it actually wore out a little bit. I had to put money back into it. So it really didn't appreciate. What happened is the money got worse. We've printed 80% of all the money in the United States. We've been a republic for 249 and a half years. 80% of all the money in that 249 and a half years came in the last 5 years. Crazy. So we've devalued the currency by a lot. That's why gold's up. It's why silver's up. It's why Bitcoin's up. It's why houses are up. Because as we devalue the base currency, the asset that you own that has to be denominated in something, like use gold. 1 ounce of gold has been 1 ounce of gold for 5,000 years. Hasn't changed, right? But the value of that 1 ounce of gold has changed. It's interesting. It's been exactly the same for 5,000 years, meaning 5,000 years ago, you could give someone an ounce and you got a fine person suit. Today, you could give someone an ounce and you get a fine person suit. It's really quite interesting. Now, Bitcoin, one Bitcoin's one Bitcoin, but we don't price Bitcoin in Bitcoin. We price it in dollars or yen or euros. Let's take today. So today people cry, oh, you should have bought Venezuelan stocks on last Friday before the thing happened. Oh, okay. So you bought Venezuelan stocks, but yes, Venezuelan stocks are up 75% in like 3 days, but the currency's down like 99.9%. You actually lost money. And in fact, in my office in the other part of the house, I have a 100 trillion Zimbabwe dollar bill. Like literally 100 trillion, lots of zeros. It wouldn't buy a loaf of bread. So I'm a trillionaire in Zimbabwe, but I couldn't buy a loaf of bread because the value of the currency goes down so much. In fact, there's no time in history where you want to have your market be the best performing market parabolically, because that means your currency is getting cremated. It happened in Argentina, it happened in Zimbabwe, it happened in Venezuela, it happened, in Turkey. You don't want to be a Turkish billionaire because your currency is down 98%. So the same thing is true here. Is I believe Bitcoin is a different use case. It's a better form of money. Money is an asset that exists in the absence of a liability. There's really only one. I mean, there's two, silver and gold. But gold is really the core. Silver is kind of secondary. Bitcoin is a better form of gold. It's equally scarce and it's more portable and more divisible. Simple example. If I had a bar of gold, which, maybe I have one lying around somewhere, but if I had it right here, I'm not strong enough to break it in half. I'm just not. Even if I could break it in half and try to send you half, I couldn't stuff it in my computer, right? But I can pick up my phone with a couple buttons, I can send you Bitcoin instantaneously. It's just a better form of money. And money is different than currency. Currency is backed by fiat, backed by debt, and governments like it, and it's a perfectly good thing, and we live based on it, but it's fallible in that it can be taken away from you. And it is taken away from you every single day, whether you live in Australia or, US or Europe, it doesn't matter. The governments are taking it away by printing more of this to fund their spending habits. So I will argue Bitcoin in the short run might go down, but over the long run, the response to that type of market correction will be more money printing, which means more value accreting to Bitcoin. We're probably more mid to late cycle in liquidity. As I said, China is stepping it up a little bit, but the US might cut a couple more times this year. even if I'm sure Powell is going to be out, here's the crazy thing. Jerome Powell has basically abolished recessions. He's done one of the most amazing jobs of Fed chair we've ever seen. He's got record high asset prices, stocks, real estate, gold, and yet Trump wants him out. I'm like, why aren't you celebrating this guy? You put him in office, right? And yet you act like this guy's a pariah, maybe the best Fed chair ever. I mean, it's hard for me to say that out loud, but the data supports that. And so I think it's interesting that somehow people think we're going to get some super dove. Jay's been a dove. When Jerome took office in 2016, he was a hawk, right? Buttoned up tie, he was a hawk. And then he became Jay the dove. He finally got bullied into cutting rates in 2018. Well, then in 2020, he became Jay, the letter J, the pusher, right? He was wearing a hoodie and a backpack, handing out stimmy checks to everybody. And then he went back to kind of Jay the dove, a little bit of Jerome hints, but stayed Jay the dove. And now he's almost back to Jay the pusher. Not quite, but I don't know that we're going to get anybody who's going to cut a lot more. The real problem with cutting interest rates at this point is GDP growth is too robust already. The problem is not demand for credit. The problem is that the GDP is basically being driven by one thing, and that's AI data center development. If you took that out, we'd have no GDP growth. And it didn't get quite as high in terms of, I thought we'd peak at around 150-ish based on, and the logic was that in the previous cycles, 17 and 21, we got to 2 times fair value. So fair value is determined by the Metcalfe's law model that Tim Peterson and others run. And so in 2017, fair value was 10. We got to 20 before we crashed all the way back down to 3. Then in 21, fair value was 32, 33. We got all the way to 69. Now, why do we get so much above fair value? Humans are going to human. We get greed, we get, leverage. And when leverage is abundant, you can get very much above fair value. And that's why you then need a big crash. Because when you start the crash, in theory, if you're 2 times above, you only need a 50% correction to get back to fair value. But markets aren't that precise. They crash right through fair value and then go to the depths of despair. So long story short,
Yusko draws a clear distinction between money and currency. Currency is backed by debt and controlled by governments. It is useful but inherently fallible. Money, by contrast, is an asset that exists without a corresponding liability. Historically, gold has filled that role. Bitcoin, in Yusko's view, is a better form of gold, equally scarce, but more portable, more divisible, and easier to transfer. A gold bar cannot be broken in half easily or sent across the world instantly. Bitcoin can be transmitted globally in seconds with a smartphone. 1 Bitcoin is always 1 Bitcoin, but we price it in depreciating currencies, which creates the illusion of volatility. The volatility is often in the currency, not the asset. Yusko cautions against celebrating parabolic asset performance. When a market explodes higher in local currency terms, it often signals currency collapse, not wealth creation.